Welcome to Investing Mastermind Podcast. My name is Signe Lundholt.
And I'm Michelle Markey.
Today, Michelle and I are going to share what the very first step we take before we invest in any stock. What's the very first thing we do when we have our wish list or our watch list that we talked about in the last episode. Then the next step is to start looking at the company, at the stock that we have on that wish list. And today we're going to talk a little bit more and go into detail about our very first steps we do. And Michelle, do you want to start out by sharing what's the very first thing you do when you want to look into a business?
Well, what I usually just end up doing is I end up putting the stock name, if I know the ticker symbol, or the company name, and then just stock. So let's say I put Netflix stock in Google, and then Google will give me a chart usually of the stock, and it has the ticker symbol, which represents what the company is traded on a public exchange. Like Netflix, I think, is traded on one of the public exchanges, either the NASDAQ or the New York Stock Exchange. And so it will show me, like, if I put Netflix stock, it will show me like NFLX, which is the ticker symbol for Netflix. So then I see a chart, and then I could see, what it was trading in, the price that day and in the last month or in the past year or since inception, like when it first became publicly traded. So I just want to get a quick look at the stock just to have an idea of what I'm dealing with. Like, does it seem like it's run up a lot? Did it go down a little bit? I just want to have some basis as to what the stock price is. And even though it's sort of funny, because in Warren Buffett style investing, we're not supposed to care what the stock price is, but I actually care a little bit. So I want to know what it is, just so I can have an understanding of this is what the market is trading it at today. And so what do you do?
Yeah, that's interesting. So I don't look at that to begin with. The very first thing I do, I look into certain numbers that I want to make sure that the company has some great numbers. So I look into return on invested capital, which is called ROIC. And then I look into return on equity, ROE, which is hopefully the same number. If it's not, if ROE is higher than ROIC, it means that the company has a lot of long-term debt. And I also do look into the long-term debt, and I calculate how many years it would take the company to pay back this long-term debt. I look at the free cash flow per share. So I do not only look at the free cash flow of the company, but I actually look at it on a per share basis, because if it's a huge company and has a huge free cash flow, or if it's a small company, it will have a smaller free cash flow. So if I only look at the number, it won't really tell me if the cash flow is great for me as a shareholder. And that's why I look into it on a per share basis. And then I also,
I just want to ask, do you look at all this first on a screener?
No, depending on which company it is, I'll calculate it myself by taking the filings, and then I have a calculator where I copy paste the numbers and I, from the filing, and I know exactly where to look and, put it into my tool.
Okay, so you get it all from the source, like the financial statements and the 10K annual report and so on, right?
Yeah, exactly. I might take a shortcut in the very beginning and either look at gurufocus.com that has these numbers, or for American companies, stockanalysis.com, and just do a quick check there. But I would definitely, it doesn't take that much longer with the tool to actually calculate it myself. One thing I'm also very interested in is the profit margin. The profit margin is the company's ability to turn income into profit. So it's income minus all their expenses. And what is important about this profit margin is that, it really depends on the sector. So I can't look at this profit margin and say, oh, this is a very high number, so therefore I want to invest in it. It really depends on the sector. Like the grocery stores have smaller margins than tech businesses, for example, but it's just to kind of get an idea. Usually I know the kind of sector I'm looking into, so it's just to get an idea of where are we, how well are they at actually protecting their income and keeping expenses low. That's what I would like to see from a management team. And for me, those numbers are really important. If they don't have, certain criteria on those numbers like ROIC and ROE on at least 10%, then I don't have to spend 1 second more looking into that company. And that's why, for me, looking into those numbers are the very first thing I do, because if it doesn't have good numbers, I don't even want to continue by reading the annual report and going into detail about the business, because already there I'm out. So for me, the numbers are definitely the most important thing, even though, I could be missing potentially companies, if there's one year where they didn't do well, but for the past 20 years, they did do well. Because what's important for me to say is that in this initial round of looking into numbers, I only look at recent numbers. When I then do some further digging, I do go multiple years back, 10 years back, and look at these numbers. So I could potentially be saying bye-bye to a company that's actually, might be going through some sort of crisis, but could actually in the long run be doing very well. So that's the risk of doing what I'm doing.
Yeah, and I do similar things as my next step to what you just said, of checking some of the high level stats on Guru Focus. And like, for example, they have a little chart. You can see some of the 1 year, 5 year, 10-year averages and some of these like earnings per share growth rate and the revenue growth rate. You could see a few of those at a high level. And some of those give you a little bit of clues if you form criteria like both Signe and I have sourced a lot of our investment checklist criteria from Invested, like the book by Danielle Town and Phil Town, and maybe a few other sources, but that is one of our guiding formulas, that we tend to check some of these factors based on what we learn from them. And then I also, say take the earnings from the trailing 12 months and factor that also into some calculations to form a preliminary intrinsic value estimation, like doing a margin of safety calculation, also again from the Invested set. So I have some spreadsheets that have these different valuation methods of margin of safety and payback time, and also the 10 cap or the 10 capitalization. So these are all formulas you could learn about in the Invested book and by listening to the Invested podcast that I
But do you look
calculate with.
into that at this time already? Do you look into
Yeah,
valuation this
yeah.
early? Ah,
Yeah,
okay.
because it's easy to me. It's easy enough to do those things. Like I will gather all the 10K reports similarly to you, and I plug in either some of the current years or a year that I think is realistic. Like let's say I think that 2021 and 2022, the company skyrocketed a lot because of pandemic demand, but maybe a more normal year was 2019, where it's like before there was a crisis and before there was a lot of stimulus. So I might take that report to do, say, an example intrinsic value calculation based on 2019 figures and see if things are getting a lot better or worse from that time. So it's not that hard for me to do from some of the existing spreadsheets that I have. So
Ah,
that's
okay.
what I tend to do next is,
Yeah, because I wait with the valuation part. The valuation means what is the stock price that you should buy the company for. And for me, that's way, further down the line. I do have the numbers of, how is management doing is basically what all of these numbers are saying. And one thing I forgot to mention is actually one thing I'm looking into is actually also revenue growth or sales growth. And it's because I really want to see increasing growth, or it doesn't have to be increasing a lot, but I don't want declining sales growth or where it's been stagnating for years. And the reason I'm saying that is because one of the learnings I had in the very beginning of one of the first businesses I looked into, I forgot to look at that number, and they weren't doing that well. Not that the stock price necessarily went down for that reason, But it was definitely something that then got into my checklist and beginner, the very first step, my beginning or first step checklist or whatever you would call it, to just look at the revenue growth or the sales of the company, where I want to see that they have increasing sales. Yeah, there's other ways, of course, for the business to expand besides sales. There's, some companies are great at investing in other companies, acquiring other companies, either fully acquire or partly investing in businesses. So you can't only look at sales growth, but it's just a parameter that I'm mindful of after that first mistake.
It makes sense and I incorporate some of those, like, because I get a quick look at that already in Guru Focus, let's say, like in their little summary. And then I already have like a little high level idea, like, oh, this has been trending at a 10 or 15 or 20% growth rate, let's say. So like I already have that as a little bit of a ballpark figure. It's not the final, but just like as a high level. And then that starts funneling into a preliminary intrinsic value calculation, because I just want to get to a quick and dirty answer right now. And then if I think it's possible, like if it's too overvalued, I don't even feel like studying it that much. Like right now, if I feel like if I did like preliminary estimations for Nvidia and I was like, this is too expensive, then I don't even feel like studying it that much. Like I tried learning about it a little bit last year, but semiconductors was a little bit outside of my circle of competence. But now that it's been bid up a lot, now I don't even feel like doing that much more work on it for now. So some of that is like, it kind of depends. Like you sort of stop and go in different phases of where you are in a company research. And, I kind of felt like I started learning about semiconductors in general without doing the valuation calculations. So sometimes I do that too. Like I might just start reading a little bit of the letters from management and see if I can understand what they're saying. And, it was still a little bit new to me last year. So I started to, but I didn't get so into the semiconductor companies. So even though I like doing some of these preliminary calculations as one of my earlier steps, I don't always do it to begin with. I might learn some other aspects of a company beforehand.
Yeah, now that you mention it, I actually also remember at some point in the beginning, I also did go in and make the valuation of the company in the very beginning for that reason. I didn't necessarily want to look into it because the stock price was way higher than the valuation of the business. But I've stopped doing that in the very beginning, also because it can be discouraging. And then in case stock price come down because of the pandemic or something like that, then you haven't done necessarily the homework. But I do also remember I used to do that. I just don't necessarily do it right away. And it's also funny that I don't even look at the stock price to begin with either. It does come pretty quickly after running the numbers and okay, what's the price right now? But yeah, I think it's more, again, what you talked about in an episode is maybe a few episodes ago, where you also, time is valuable. And I think that's why I just cut it down to what I believe is super important. And I might, like I say, be missing out on opportunities because I'm so focused on the numbers instead of really doing more work before I just put it in my too hard box, which I call, if there's a company I'm not going to invest in, I put it in my too hard pile. And that comes from Warren Buffett. He has a tray in his office. And when there's a company that's outside his circle of competence, a company that he doesn't understand, he puts it in that tray. And I say a company is too hard for me to understand. Like my parameters of too hard is, there's so many companies I don't understand. And even if I understand most of the business, if there's a little tiny detail I don't understand, then I'll say it's too hard for me. Even though, yeah, I do understand the business. I do, but there's something that makes it too hard for me to understand. Like, I don't know why they made the decision. Boom, too hard.
Mm-hmm. Makes sense. And we come across those junctions and have to decide, where do we move from here? And yeah, I mean, sometimes you're not ready yet. As much as you want to really get into it and want to understand it, sometimes it's still a little bit out of reach. And you have to know yourself, like, what really this is about, as much as you might be eager. Like I was very intrigued when I saw Berkshire Hathaway invest in certain companies, and then I was trying to start learning about them. But then either I didn't really understand them or I lost interest because it wasn't really something I cared that much about. So yeah, you have to kind of make those judgment calls. And even if you feel like, oh, I spent all this time to learn this and figure it out, and then you might feel like you need to take an action, like you might want to preemptively buy it because you're like, oh, I already devoted this much time. But it's okay to step back too and say, like, you know what? Even though it felt like maybe some of this was a waste of time, but at least now you learn more and you can be okay with taking a step back and not making a decision when you're not ready to.
Yeah, and you might be able to actually use that information that you got for another business at some point. You might actually have learned something, so it wasn't just wasted time. Also, last episode you brought the concept of wish list and watch list. Right now the stock is still on the watch list, but once I've run these numbers and found out, oh, okay, this is actually looking good, this stock will move up to my wish list and I will go more in detail with the stock or with the company. And then potentially it could be moved out of the wish list once I find more information. But at this time, once I've run the first couple of checks, it does move up to, okay, now I want to learn more about this business.
And another thing I do related to the wish list is if I do feel compelled to sort of preemptively buy just because, like, it seems very exciting and I want to learn more and care more about it, I might buy one share, a single share, as like a practice share, as like you're getting your feet wet a little bit so that you have a little more skin in the game. Because now that you put some money on the line, now you're like, okay, I better study this because I did put a little bit of money at risk. It's not so much that you're like worried that you will lose it, but more like, okay, now I'm more motivated to learn more about some of these companies. So I've done that too, where I might buy one or a very small amount of shares just to get more into it.
Yeah, and I remember you mentioned that, and I actually found that very inspiring, and I want to do that at some point because I really think it's gonna catapult me into really doing a good job on doing my research on a company. Like sometimes you get started and then kind of lose momentum, and then it's very, very difficult, at least for me, to then get back in. I'm much better at just, once I decide, okay, now I want to look into this company, then doing everything all at once. And maybe that method that you're talking about there would then help me, with some of the companies that just never moved any further on my wish list. If I just, got a little bit of some skin in the game, maybe that would help me, move on instead of just passively not doing anything. So I really like that concept.
I mean, it can be good and bad. I mean, sometimes I still feel apathetic about a holding. Like I tried doing that when Berkshire Hathaway bought some Activision Blizzard, and I was like, ooh, like Activision Blizzard. So I bought one share of ATVI, and then I thought I was going to study it, but then I was like, I still don't care that much. So I ended up selling it at some point. But that to me, that was not a big risk. It was just, it almost maybe might have spurred me to look into it more. But then I realized I'm still not that passionate about the video game industry.
Oh,
So I
that's one
kind
of
of
the
just,
industries I've been
you've been
really
more
digging.
interested in.
Yeah, I've been digging into that one
That's
and
great.
knows the companies pretty well. So
That's great.
it's
Yeah. So
yeah,
yeah,
Activision is not a bad company, but
well, I'm sure it is pretty good, but like, you see, you have to combine these two things of both a potentially great company and something that you are finding yourself interested in. Because for me, I just was not that interested, even if it is great, like it's cool and everything, but I just did not get myself over that hurdle yet. So for me, I put it back on the maybe watch list. Maybe I'll get back to it someday if I find myself caring more. But for now, I'd rather focus on something else.
yeah, and I found that the gaming industry had a lot in common with the toy industry that I was working in at that time. A lot of the things I definitely, where I could see some parallel, especially with communities and things like that. So for me, it was very interesting to dig into gaming. All right. With that, it's time to say goodbye for now. We're back on Tuesday.
Till next time.
If you enjoyed the show and found the content informational, we would be super grateful if you would leave us a review and follow us wherever you get your podcasts so you automatically get new episodes in your feed. We publish a new show every Tuesday.
The contents of the Investing Mastermind podcast are for educational, informational, and entertainment purposes only. None of this is investing advice, and if you need help in your personal situation, please consult with a professional.